Hi, and thanks for watching. In this video, we're going to talk about what stocks are and how the stock market works. So this is a video for beginners, and I am personally studying to become a day trader. You might be watching this video for various other reasons. You might be into day trading as well, or you might want some basic information about investing in stocks. So this video is a beginner's guide to what a stock is and how the stock market work. So we're going to cover this article that we have on my website, stokestrades.com, Stock Market Simplified, a beginner's guide to understanding what stocks are and how they work. So, what exactly is a stock? So again, personally, I'm pursuing a career as a day trader. So I kind of feel like I need to refresh this information for myself. I have some background information. You probably know like a little bit about what a stock is, but we want to just cover in this video a really easy explanation. So let's jump right in. This is what a stock is. A stock, it's also known as a share or equity. So those kind of three terms are interchangeable, and it represents ownership in a company. So when you buy a stock, you are buying a piece of the company's financial profits and assets. So you own sort of the company. But for me, and maybe for you too, that definition is a little bit vague. So I want to dive into an example that sort of helps explain this concept of ownership a little bit better. So you own a stock, you own part of the company, it's kind of not super clear. So let's go into this example. So let's talk about this example that has to do with Tesla stock. So I own Tesla stock. There's a lot of good people that share educational information about Tesla stock in various online communities on YouTube, on X. So there's this person called Jason DeBolt. He did some calculations based on the amount of shares available. And then he discovered through the amount of shares available that 100 shares equals 1 second of production in the whole Tesla company. So if we kind of just pick a more round number, if you own 6,000 shares, this represents 1 minute of production per year in the whole company Tesla. So now imagine everything this company does across all of its factories. So it has factories in California, various other locations in the United States, Texas, it has a big factory there. It has a factory in Berlin. It has a factory in Shanghai, China. It has various other factories and warehouses and, retail stores and all that sort of thing. So now, look at your watch, count 60 seconds, and everything that Tesla is doing for 60 seconds, you own that much one time per year if you have 6,000 shares. So 6,000 shares is a lot of shares, but that's a sort of better representation of what you own when you own stock. So, let's pretend I own 6,000 shares. So every year I can look at my watch, I can count to 60 seconds, and everything that Tesla is doing in that time frame is what I own. So that's part of my ownership. So it represents ownership in the company. And again, the amount of shares will differ, will represent sort of a different amount that you own. And if you do it sort of timeline like this, then you can sort of, extrapolate these shares back. So if you sort of only own 100 shares, then, that represents 1 second in this example. And if you want to do this for other companies, other people might have created other sort of calculations based on these different metrics. But that's sort of just a better understanding for me. So when I think of my stock in Tesla, it goes up and it goes down, but I'm never going to lose that 1 minute if I own 6,000 shares. So the price might be going up, or, for various reasons, the stock goes down in the short term, but I still own those 6,000 shares. I still own that 1 minute every year of production. So that's the way I like to think of it. And it's sort of an easier explanation for me to understand this concept of ownership. Now, ownership, it comes with certain rights as well, such as voting rights when there are shareholder meetings, and then potentially receiving dividends which are a share of the company's profit. So Tesla specifically doesn't offer dividends, but other companies do. And if you own shares, then you get a bit of dividend payments throughout the year. So how do these work? How does a stock work? So let's quickly review, why stocks even exist in the first place. So back in sort of the 17th century, or maybe a little bit earlier, the first company issued stocks to the public. So why did they do this? Well, by issuing stocks or issuing a share or issuing equity in their company, they get money in return, and that helps fund their growth. So the money is used to fund their growth and their operations. So today, when you want to issue shares, if you own a company, then you will do it through what's called an IPO, an initial public offering. So this IPO is the process of going public, from a company moving from a private company to a public company. And this is when they offer their shares to the public for the first time, and they receive that money in exchange, and then they can fund their growth. So if you're a company, you're just starting out and you want to grow, you want to go public, you do an IPO, you sell your shares on the market, people buy them, and you get that money, and you can do further research and development and further growth and so on. So there are many reasons why a company might want to go public, but the main one and the easiest one to think about is to raise capital or raise money. So when a company gets listed on the stock market for the first time, people can buy shares of the company and they receive that money. And again, this is money that they use to grow their business. So how does the actual, stock market work? Well, at the time of, recording this video, Tesla stock is around $250. So we're early January 2024 here. So if you invested $1,000 in Tesla at their initial IPO, you would have over $220,000 today. So the stock market is where shares of public companies, such as Tesla and all the other public companies, can be bought and sold. So you can sell and buy shares of companies on the stock market. So people like you and me, and we're called retail investors, can buy and sell stock, along with institutional investors. So, companies or organizations that buy stock for their clients. So remember, stocks are investments. The stock market is where you buy and sell investments through various stock exchanges. So Tesla, when they issued their IPO and they sold shares to the public, people bought those, and that is an investment. And if you had done that and you invested $1,000 back when their official IPO was released, now you'd have over $220,000. So stocks are investments. And when you buy and sell stock, you are buying and selling it from other investors, not the initial company. So when they do the IPO, you buy shares from the company initially, but throughout its life, and as the company grows, and as those stocks are no longer available from the company, you buy and sell them from other investors like me or institutional investors and so on. So during Tesla's IPO, its shares were listed on the NASDAQ. So the NASDAQ is what's called a stock exchange, where many tech companies and internet companies get their shares listed. So you can think of stock exchanges sort of as a marketplace where the stocks are bought and sold. And there are several stock exchanges around the world. So again, the NASDAQ is an exchange in the whole stock market where internet companies and tech companies list their shares, and you can buy and sell them on that exchange. There is several other exchanges. The New York Stock Exchange is another big one in the United States. Then there's Shanghai Stock Exchange, so that's in China. There's a Hong Kong Stock Exchange in Hong Kong, and Europe has one as well. So companies, in Shanghai, in Hong Kong, they would do their IPO and they would get their shares listed on the stock exchanges that relate to their geographic location or whatever their company sort of what their company is classified in. So NASDAQ is the tech companies, internet companies, and so on. and so on. So there are also market indexes. So these differ from actual stock exchanges. So market indexes, these are statistical measures that track the performance of a specific group of stocks. So the popular one that you may have heard of and that I've heard of is Standard and Poor's 500 index. So the S&P 500, and this includes the 500 largest companies listed on stock exchanges in the United States. The other one is the NASDAQ Composite Index, and that includes all the stocks that are listed on the NASDAQ Stock Exchange. So these are the tech companies, internet companies. So these indexes help you track the performance of various markets and segments. So you can kind of track how the 500 biggest companies in the United States are doing growth-wise or performance-wise through this S&P 500 index. And again, there are many other main indexes. There's the Dow Jones Industrial Average, and there's the NASDAQ Composite, the S&P 500, and so on. So in order for you to buy and sell shares of a company on these various exchanges, you're going to do it through a brokerage firm. So if you think about it, there's these companies and there's shares getting traded on these various stock exchanges. How do you and I go out and actually buy some of these shares? Or how do we sell them to other people once we buy them? Well, we do that through a brokerage firm. So there are many different firms that you can use. And these days, you can just sign up and use an online brokerage firm. So, when I was first getting started, when I first bought my stocks, I would have been, 2018 or so. So about 6 years ago, I remember thinking, how am I going to buy a stock? How does this work? Do I need to go to an investment company in my location and get these, this investment firm to buy this stock for me? Well, no, you don't need to do that. You can just sign up with an online brokerage firm. So I'm in Canada. I signed up with Questrade. I did a little bit of paperwork. I e-transferred money from my bank account to my Questrade account, and I went and I bought Google stock, Apple stock with that money. So brokerage firms help you facilitate buying and selling stocks on exchanges. So you don't need to worry about, signing up and getting access to the NASDAQ or the New York Stock Exchange or any of these other exchanges. You do this through the brokerage firm. You just click a few buttons to buy and sell stock with the money that you deposit from your bank account on these platforms, and they do the buying and selling for you. So, 10 popular brokerage firms that you might have heard about in the United States: Charles Schwab, Fidelity Investments, TD Ameritrade, E-Trade, Robinhood. So that's a popular one for mobile devices and so on. Many retail investors use that one. And then for me, I'm in Canada. Common ones in Canada, we just use our banks sometimes. So RBC Investing, TD Direct Investing. And then you can use independent online brokerages like Questrade. So I use Questrade, and Interactive Brokers is one that I'm going to use for my day trading needs. And so once you sign up with a brokerage account, again, you simply just transfer money to the brokerage account from your bank account, and then you can buy and sell stock through the brokerage. So they act as sort of the intermediary between you and the various stock exchanges. So it's actually really, really easy to do now. Whereas, maybe the last decade or, when these brokerages weren't around and they weren't easily accessible online, it would have been much harder for the average person to go and buy a stock. You would have had to kind of jump through a few more hoops. Now, lastly, what we'll wrap up in this video is just talk briefly about stock prices and sort of how they work. So let's do a Tesla example, sort of expand on that example that we've been sort of talking about to sort of understand how price moves. So I'm just going to read this boring definition of how a stock price might move. So the price of a stock is primarily determined by supply and demand dynamics in the market. So this means that, if more people want to buy a stock than sell it, the price goes up. And if more people want to sell than buy, the price goes down. So the pricing is also influenced by investor perception of a company's future prospects. financial performance, and the broader economic conditions. So stock prices are set through an auction process on exchanges where the balance between buyers' bids and sellers' asks determines the final price. So let's do a quick example or a quick discussion of Tesla to sort of make this a little bit more clear. So when Tesla first went public, its stock price was significantly lower than it is today. And as I mentioned, earlier, at the time of reading this and producing this review, Tesla's stock price stands at around $250. So this remarkable increase in stock price over the years can be attributed to several factors. And remember, if you invested $1,000, that now is worth $220,000. So the stock price has gone up from when Tesla first came on the stock market to now 220 times. So as Tesla grew, developed new technologies, expanded its production capacities and capabilities, and reported increased sales and profits, more investors, they wanted to buy its stock, seeing that the company as valuable as it was and seeing its potential for future prospects. So this increase in demand, more people wanting to buy the stock because they're seeing how well this company is doing, coupled with a relatively fixed supply of shares. So Tesla didn't issue way more shares. So it issues its shares and it's a relatively fixed number. The demand goes up for these shares because Tesla's doing so well. That drives the stock price up. So Tesla's innovative approach, in the EV industry and its influence on, the automotive market played a critical role in their stock price going up as the company, achieved various milestones, garnered positive attention, investors' confidence grew, and this fueled more demand for Tesla shares. So the stock market, where shares of companies like Tesla are traded, it operates on these principles of supply and demand. As Tesla became more valuable as a company, the demand for its shares increased, leading to a rise in its stock price. And this is sort of a clear example of how a company's growth and success can directly influence its stock price in the market over the long term. So Tesla is a stock that's very volatile in the short term. It can go up and down for no apparent reason. But if you sort of take this long-term investing view with this particular stock and this sort of example, you can see that over the long term, what Tesla has done successfully has driven the stock price up. So as we mentioned, $1,000 is now worth $220,000. So this shows the potential or the significant returns that can be achieved in the stock market depending on the companies that you invest with. But don't forget that stocks don't always go up. Just like they can go up, they can come crashing down along with your potential profits if you sell these shares. But as we kind of talked about in the beginning, the stock price can move up and move down. But if you don't sell any of your stock, you're still going to own that 1 second of production in this company. For example, if you had 100 shares or if you have 6,000 shares, you're still going to own that 1 minute of production every year. And that is not changed based on the price of the stock. So, if the stock goes down, you still own those 6,000 shares. You still own that 1 minute of production. And then as the stock goes up, again, you still own that through the amount of shares that you own. So to wrap up this video, we'll just quickly go over some key insights that we talked about. And then I think we'll wrap this up as a good beginner video for what a stock is and how the market works. So again, stocks represent ownership. So owning a stock of a company means holding a piece of a company's profits and assets. And the example we talked about, owning Tesla stock equates to owning a fraction of the company's production capacity. 100 shares is 1 second every year. 6,000 shares is 1 minute every year. The historical context of stocks. So the concept of issuing stocks, it started in the 17th century as a means for companies to raise funds for expansion and operation. And now, in today's day and age, we do it through IPO. So there's an initial public offering that marks the transition of a company going from private to public, allowing it to raise money for its growth through offering shares to the public. Stock market dynamics. The stock market, it's a platform where shares of companies like Tesla and other companies are traded, and includes retail investors like you and me, institutional investors, and it's facilitated by various stock exchanges that are located all around the world. So the NASDAQ is the one for tech companies, internet companies, and there are various other ones as well. So these exchanges, they serve as the marketplace for buying and selling stock. And there are also market indexes that we talked about. So one, the S&P 500, which lists the 500 biggest companies in the United States, the NASDAQ composite. Again, these track the performance of a group of stock, and this provides insights into market trends and how the economy is doing. Brokerage firms are the intermediaries. So brokerage firms, online and traditional ones, they act as the intermediaries for you, an investor, buying, selling stocks on these various exchanges. So these are the platforms that you do the buying and selling on. Stock price determination. So again, prices of stocks, it's determined by supply and demand. So as well as other factors like the company's performance and investor perception. So again, as a company's performing well, investors' perceptions of the company and their thought that their future profits could go up will drive their stock price up because more people want that stock. There is a potential for high returns in the stock market if you are buying good companies and holding on to them. They have a lot of potential for significant returns, as we saw with this Tesla example. But again, there's always risk involved as well. Stocks can offer high returns, but they can also decrease in value, which highlights the importance of understanding various market risks. So I hope that you found this video useful. This was a personal refresher video for me. I am studying to become a full-time day trader. I wanted to just get a good basic understanding of what a stock actually is, how the stock market works. And again, this was a beginner type of video, and I hope that you found it useful. So please subscribe to this channel if you're interested in becoming a day trader yourself, or you want to learn more about the basics of day trading and sort of come along with this journey as I become a full-time day trader. So thanks so much for watching. Subscribe to the YouTube channel, and I will see you in the next video.